One of the questions, as many of you have asked, and it's always a loaded question and really hard to answer, is are we at a bottom? How close are we to a bottom in this market, or possible recession, or any number of things? We are invested alongside with you, our clients. We own portfolios, we own managers. We certainly understand the frustrations, the nervousness around these type of markets every time that they go down like this and there's talks of a recession. Understanding that each one of our situations and our timelines, the money we have invested, is all different, but really when it comes down to it, we feel a lot of the same frustrations that you all, our clients, do. And we would not be accurate if we didn't admit that it crosses our mind once in a while of, if I could just get out of the market and I could just get back in and I could time it, I'd avoid some of the pain. And while that temptation is there for us, we also have the benefit of being in this business and being an investor for over 2 decades, and we understand the futility of that effort of trying to time the market. Number one, as history as a guide, but number two, as experience as a guide. Every time that in the past that maybe I've tried to outguess the market, make a call, it usually hasn't gone well, and it is very, very difficult to time the market, if not nearly impossible. So what do? Well, I believe, and what we've worked on for years with you, our clients, is that we build prudent portfolios, we manage risk as much as possible to try to mitigate the downside to the extent that we can. And we don't panic, and we stay invested. And there is no clearer, more recent example that I could think of than in the past couple of weeks, when we had a 1-week span where the indexes like the S&P 500 or the tech heavy index, the NASDAQ, or the Dow 30 largest companies, a few weeks ago, it had its worst 1-week return over that short time span that it had had since 2020. And I'm pretty sure most of us that Friday thought, oh my gosh, next week's going to get even worse. To most people's surprise, probably even mine, one of the best weeks in the market followed that worst week since 2020. In that week following that horrendous week, the market averages were up anywhere from about 5.4 to 7.5% in one single week. And this just highlights, although it's not a long-term trend and there's probably more pain in the market and we don't know exactly what's going to happen, but it does highlight how difficult or nearly impossible it is to try to time the market when you have the worst market week in a couple of years, followed by one of the best market weeks the next following week. So on to the subject, are we close to a market bottom? Our educated guess that we build based on our many partners that we work with and Raymond James and other data that we look at is maybe it's not any better than anybody else's guess. But we certainly look at history as a guide, and we try to form an opinion to try to, if nothing else, help you, our clients, with confidence in your investments and investing for your future long-term goals and dreams. Whether or not we're at a bottom in the market right now probably depends on whether we have a recession in the next few months or not. If we don't have a recession, and we won't know till after the fact, but if we don't fall into a recession in a few months, or if the recession that we would fall into would be very mild, the markets have probably sold off a lot based on that fear of that happening already, because the market is typically a leading indicator of what they think is going to, investors think is going to happen in the near to intermediate future. So, barring a recession, the market's sold off quite a lot already. If we have a recession, then certainly there could be more downside in the market, and no one can for 100% accurately predict that. I want to share just a couple of quick things from Natixis. They put out their macro commentary that they send to us advisors with some of their thoughts on where we're at, what's going on. I'll share a couple of those with you real quick, and then we'll close it up. So first, what would be a couple of catalysts for the market to actually move higher? A couple things, three things that could happen from here that would be a positive for a positive direction in the market. One we already talked about is the fact of avoiding a recession in the next coming months, or having what the Federal Reserve would call a soft landing or a mild recession. That would certainly bode well for the positive direction of the market in the near term. A weakening dollar. I won't go into all the details, but contrary to what a lot of people would have thought, our dollar has remained strong, and a weakening dollar would actually be a positive sign for some market movement on the upside. Interest rates topping out. Interest rates in our market, based on what traders are buying and selling, have been pricing in the interest rates a lot of rate hikes. Now, whether we end up having all of those or not, again, who knows for sure, but there's been a lot of speculation of how much the Fed is going to raise rates, and that is driving current interest rates up. You've seen it in mortgage rates, you've seen it in other rates, and those calming down, or at least stopping the rise in those interest rates and that speculation, would be a very good thing for the direction of the market. And then one thing we haven't seen yet that we will probably see in the near future, hopefully, is some of the inflation cooling off. Now, we've seen some signs of inflation cooling, although certain things that we depend on, like gas and heating and cooling our house and food, and some of those things that we have to have remained stubbornly high. Underneath the surface, there are quite a few different things that are breaking down. Inventories at stores are on the rise. Companies are looking to put 25 to 50% sales on some of their goods that they can't move. So that remains to be seen whether that shows up in this next month's data, the next month after that, or the next month after that. That's what we don't know. We thought it would have happened a month or two ago. It has not yet. So that would be another positive thing, a catalyst that could drive the market higher. Let's talk just real quickly about some charts. So number one, sector performance. So a lot of the sectors that have contributed to the market going down the last few weeks and the last few months, again, remember we mentioned that week of very strong market performance. In that strong week of market performance, a lot of those sectors that have been beaten up were the leaders, and a lot of the other sectors that have been holding up better were the big laggards during that good week. If we saw more of that, that would be a very positive thing for the market if a lot of the laggards the last few months became some of the market leaders in performance. As we mentioned earlier, there are a lot of signs of certain commodities cooling or prices rolling over as reflected in the chart. The other thing is investor sentiment or bearishness of investors is at an all-time high going back to 2008, as you'll see on the chart. So basically 60% or more of respondents surveyed recently believe that we are in a bear market and things will not get better for a long time. To get that a little bit of perspective and a little bit of color, when you look back to 2008, the bearishness of consumer sentiment toward investing was around 60% of investors that believed we were falling off of a cliff and things would not be better for a long time. Again, that would be another good sign that maybe the market's getting oversold, and at some point we find some market bottom and move higher based on most investors and most people out there thinking we're falling off of a cliff. And then in the last chart, just 2% of the big stocks, the big companies out there, are trading at prices above the average that they've traded at over the last 50 days. And to put that basically into perspective, that means that 98% of the biggest companies out there are trading below their 50-day averages, and you'll see that on the chart. That is a very bearish signal. That is a sign that most investors, institutional and individual, have thrown in the towel and given up. And that's what it takes to move higher is, people that are going to throw in the towel, give up on investing. There are always buyers and there are always sellers in any market. And when we reach a plateau and a down market, a crescendo, and we don't know that we're there yet, but when we reach that, all of the sellers are exhausted and selling, and all of the buyers are licking their chops, coming in wanting to buy those investments. And when we reach that point, the market will move higher.